Morning, Amanda.
Good morning, Simon. How are you?
Very well. A bit cold today. What's it like in the UK?
It's bright for a change, but it's been raining most of the weekend, so everywhere is completely saturated. But I wouldn't mind if it just went cold, actually. But yeah, dreary, grey.
Yeah, it's 20 degrees. So it's a bit warmer.
Oh.
I won't gloat on that. Okay, so this week we have two guests. We have Patrick Way, QC from Field Court Tax Chambers, and we have our very own Jane Deeks, who's our VAT specialist. So we're going to cover off some interesting bits on stamp duty with Patrick, and then we'll go and deal with some property issues with VAT, VAT groups, options to tax, the usual things that we get asked by most clients. Morning, Patrick. Morning, Jane.
Good morning. Actually, I meant to ask Simon, where are you, Simon?
At Marbella.
Oh, I'm so pleased for you, Simon. That's great.
I'm not.
I've been stuck here since March, really. So, and of course, with the travel back to the UK and the quarantine.
Yeah, I'm even more pleased for you. That's good. Right. So, shall I crack on, or do you want to?
Yes.
So, what I'm going to talk about is this thing, ATED, annual tax on envelope dwellings, and we're going to have a look at SDLT, as you say. But the thing I think is interesting is that we're looking at structures a lot of non-domiciled clients had for a very long time to hold their properties in the UK. And why did they have them? They had them because they were very good inheritance tax structures, weren't they? So you could have typically you had a trust owning a company, and then the company, which was a foreign company, owned the property. There were all sorts of ifs and buts and difficulties, but that was the sort of structure. And we all know inheritance tax, non-domiciled person, you just look down to the first asset which was shares in the foreign company. Bob's your uncle, as they say, no inheritance tax. Then along come the revenue, and they don't like this, so they think of all sorts of ways of upsetting our non-domiciled clients. And the first thing they did, I think, was ATED, annual tax on envelope dwellings. And they just said, if you've got a nice residential property owned by a company, we're going to tax you a lot of money. And when I say a lot of money, I mean a lot of money. The sort of properties which we're all looking at, not the ones I've got, probably the one like you've got, Simon, I would think probably in Marbella. Maybe not. Anyway, if you've got one, Simon, that's more than 20 million, you're gonna be paying 236,000 a year. So I hope the camera doesn't shift around to the rest of that property, but I think we're okay. But if it's more than 20 million, you're paying 236,000 a year. If it's more than 10 million, you're paying 118,000. So that's on top of everything else. So clients want to get rid of it, and they may as well get rid of the structure because it doesn't work for inheritance tax now anyway. They changed the rules on inheritance tax, and if you've got any residential property in the UK, the excluded property rules don't go. Oh, and they tax capital gains now. In fact, it's corporation tax at 19%. So what's the point? So you've got a structure that doesn't save capital gains tax to corporation tax, doesn't save inheritance tax, and costs you 118 grand if it's more than 10, and it costs you so you may as well get rid of it. Now, then how do you get rid of it? If you were just to look at the structure and you were just to say, well, why don't we do a dividend? Let's just dividend the property up. The problem with that is that's a dividend of foreign source income. Your client starts living in the house, and that's a whacking great 45% income tax charge. So you don't want to do that. What about capital gains? If you've got to watch capital gains massively, and if there's a big gain on the property since the company bought it, be careful, because you're gonna have that tax, and then it's going to be remitted when the client is living there. So with the fall in prices in London properties and elsewhere, I mean, I know outside London they're shooting up, this might be a time to collapse the structure. The way to collapse it is to avoid there being a dividend, and the way you do that is you liquidate the company. We know if you liquidate a company, looking at the 2010 Act, around about section 1033, something like that. If you have a distribution pursuant to a dissolution of a company, then that doesn't count as receipt of income. It's not a distribution. So your first port of call is you want to liquidate the company. Now, typically, obviously, it'll be a foreign company, so you need to go get foreign advice.
Formally liquidated, Patrick. So it's a formal liquidation, not just
yeah. Although, in fact, if you look, it's a good question. If you look at the manuals, they say as long as it can be a dissolution in a foreign company, as long as you're satisfied it would fit into the general ambit of what the UK authorities would think of a liquidation. So, yeah, the Jersey authorities may be able to do it less formally than otherwise. It's worth checking. So, point number one, you want to dissolve the company to avoid there being a distribution. you need to check whether you've got a capital gain, because if there is, there's going to be a big tax. But you've avoided your big income tax charge by having a dissolution. The killer is often stamp duty, because very often, stamp duty land tax, I'm going to call it stamp duty because everybody else does. Very often the company will have borrowed a lot of money. So in my example of a 20 million property, I wish they may have a 10, 15 million pound borrowings on it. And if that borrowing passes up on the liquidation, then basically what's happening is the person who takes over the property, your client, is treated as taking over the debt, and that's the same as if they've paid for it. So if they pay 15 million, I can't do the maths, but it's a lot of money. It's around 2-3 million pounds of SDLT. So what you want to try and do is find a way of getting rid of that debt. And this is where it gets difficult. The revenue accept, by and large, that if you can genuinely pay it off, then that's not a problem. And what a lot of people try and do is to see whether they can pay it off or get the bank to release the debt for a period of time. This is where, on this sort of podcast, I can't really go into great details, but if you're going to do it, be very, very careful. But if you can remove that debt so that it passes up debt-free, and then in due course, perhaps you can give different security for the borrowings, that would be good. Another way, excuse me, to seek to somehow see whether the client could put money into the company to pay off the debt. But this is the big problem, is always this area.
Okay. Yeah.
Stamp duty has this dreadful section 75A, which is the walking, talking, sleeping, whatever it is, furnace and Dawson built into stamp duty. It just basically says if you do anything involving a number of steps, and we think you've avoided stamp duty, you don't even have to avoid stamp duty, but there is stamp duty that's avoided, then we can effectively look at what we think the real transaction is, and we can tax that. So I think at a million miles an hour, people do need to look at these structures, Simon, don't they? Because there's no point having inheritance tax. There's no particular, and now you're paying all this huge amount of money. For the traps are, watch out for the distribution. So make sure it's a liquidation. Check what we still call capital gains, even though it's a foreign company, it pays UK corporation tax.
Yep.
Check for that. And watch this debt. The debt is the real problem. So that's.
With stamp duty, yeah. Is there like a one size fits all solution to? Because most structures were fairly commonly implemented.
I don't think there is. I think that liquidation definitely is the way to go. But always check the gains. I think with the in relation to any outstanding debt, there are try and get rid of it if you can. I mean, that's easier said than done. See whether perhaps you can organise perhaps to capitalise the debt in some ways. And if you look in the revenue manuals, they do actually give you quite a helpful steer as to how you might do it. But they always say, don't they, Simon, you won't be surprised to hear, but they always say, but it's always going to be a question of fact, how we feel about it. In my rather cynical view, the more money at stake, the more they tend to think, well, maybe that didn't work. So just be careful. But I think have a look at these structures, see if you can get rid of them. Watch out for SDLT, and don't, if you've got a massive gain, be very careful and watch out for the deemed income. But I think a lot of non-domiciliaries are obviously getting extraordinarily fed up with paying these huge amounts of tax living in these properties, and with the inheritance tax saving having gone, what do you do? And I think there's another point on inheritance tax, which is that you used to be able to reduce the inheritance tax bill by debt, didn't you? So but now the only way you can reduce inheritance tax is in relation to debt, is if you've taken out the debt to acquire the property. In our example, that's not going to happen because it's passing up on a distribution. You can't use the debt route. And so what you often advise non-domiciliaries to do as a short-term thing is to just make sure they've got a good will. And if they can will the property to a surviving spouse, as long as they're both not domiciled, then the full spouse exemption applies. And I mean, that's a short-term thing, but it just means if people are worried, then at least you can say, well, on your death, it will pass, say, to your wife or your husband, depending which it is. And then at least they can take steps perhaps to sell the property, as it were, and then they've got foreign they can deal with foreign cash and so on, and inheritance tax planning can resume.
So in your experience, is the trust that owns the company, is that sat there for other purposes, or is it generally purely sat there for the purpose of owning the shares?
I think it's just there for owning the shares. It doesn't do a huge amount, does it? Because
So the trust is going to be sat there even if you dissolve the company, the trust.
well, you see, the ones I've seen, they don't necessarily need a trust. They've often owned directly. But you are absolutely right. You've still got the trust there. The trust isn't then doing very much, but at least you've got rid of the ATET. So that's, I mean, the trust was typically there to give you flexibility over the shares, but you don't particularly need it for that structure anymore. And you certainly it doesn't add anything from inheritance tax saving now that the savings.
Okay.
It's quite a penal structure, and it's also massively complicated. Like you said, debt is always a big issue, whether you're doing any incorporation of portfolio. The debt issue, of course, if you assume that, it's
yeah, I mean, what I gather is that, I mean, I don't move in these circles, but I gather that George Osborne just hated these structures. It drove him insane that these foreign bankers could come over here for a period of time and not and avoid all known tax. And so, bizarrely, he, as a Conservative Chancellor as he was the one pushing all these changes. So pushing the change to non-domicile rules, this other point where, if you are a returning non-domiciled person, and I think this may happen a lot in relation to Hong Kong. So we all know that if you're not domiciled, you can be here for what it is 15 years before you're deemed to be domiciled. But if you were born here, and then you come back here, the minute you come back, there's a year for one or two taxes, you're fully UK domiciled. And I had a case the other day where I was dealing with a Hong Kong family, and the son, who's about 40, he was thinking of coming to the UK. But what had happened was when he was born, his mother had thought, well, the best place to give birth is in a London hospital. I don't know why they think that, but anyway, that's what she thought. So she flew over a month or two before the birth, gave birth to this son, and then went back to Hong Kong. So that was the brief time he spent in the UK when he was a few months old. That really doesn't help. So, and you can see with Hong Kong, with all the news about, a lot of, I think they're called Hong Kongers, aren't they? A lot of Hong Kongers wanting to come back to the UK with all the problems. I can imagine that if you're acting for them, you'd want to check, where you're born. If you're born in the UK, the minute you come back, one or two changes, different taxes, that's going to be an issue. So it's interesting. But on the non-domicile front, I mean, it is quite an interesting area because I've just been advising an Indian client, and I think the same happens with Pakistan, and I think Italy, and there's one other country that's got a very unusual double tax treaty. But particularly with Indian and Pakistani clients, the point about it is the double tax treaty we have with those two countries, India and Pakistan, predates inheritance tax, which was what, 73, 74, something like that. As a result of that, it means that the deemed domiciled rules don't apply. So therefore, if you've got an Indian guy who is domiciled in India under general principles, even if he or she is deemed domiciled in the UK, in relation to non-UK assets on their death, they should be able to avoid inheritance tax. So just worth having a look at that treaty, and I think the same with Italy. There's one other, I can't remember which it is, but it's just one of those odd hangovers, isn't it? From
we've got a client at the moment who they live there. I think they're Pakistani or Indian. They're living in Belgium for the past 20 years in the UK. The portfolio's here with their children who are going to run the portfolio, but he now wants to move to Greece to settle down. So we have to look at the wills issue and tax planning issue, as well as trying to form a structure where they can have it in a more efficient manner, plan and hand it down to the next generation. But that's quite a good case.
Yeah. Because there are all these odd rules, aren't there, about real estate. You have to have a will in the jurisdiction where the real estate is sometimes, and then the killer is that everybody that does a will. I used to do wills. The first thing you do is you get your pen out, you write the name of the clients down, then you put I revoke all wills, and then you get. But you don't want to do that because if you suddenly find, well, I'm doing a will in Greece for this property, and you've suddenly revoked. So it's not that difficult. You have to just have your wits about you. a cup of coffee before you do it and make sure you're making all the other wills. It's a bit of a nightmare.
I made that mistake because I had a will in Ireland, Spain, and in the UK. But when my wife went to Ireland, she died. But of course, the will in the UK revoked the one in Ireland. So
it's easily done. It's easily done, isn't it?
It was a bit of enlightenment. Anyway,
yeah.
About a year to sort out. Sorted.
Okay, well that's me done. So that's I'm happy to discuss together. But all very interesting, and I think it's going to be, you know, ATED is just such a huge impost on people, and obviously, I mean, there's a few other points. I had one just now where you do look at all the provisions carefully. That I've got one. It's a beautiful house in Kensington, and it's got a beautiful staircase. And I mean, I don't know about you. I don't know what your experience of builders is, Simon. I've got some. If you find a good one, you cling on to them forever, don't you? So my wife and I, we had a whole portfolio of plumbers and builders and electricians, and then they were all, unfortunately, moved on. So we've now had to rebuild our portfolio. We've just finally got all the good ones. Well, this chap with his beautiful staircase, he didn't have a good one, but it made me think of the ones I used to have that weren't so good. They've got a beautiful marble staircase, which is probably 200 years old or something. So they decide to cover it with their cloths to make sure. What do? They nail the cloths into the marble, and as you go, so gradually the marble. You can imagine if you wanted to crack marble, what would you do? You'd put like 60 nails. Anyway, this 600,000 pound staircase is cracked, and the point about it is, this is typical of us professionals seeing the sort of the silver. Every cloud has a silver lining. Is that means that the property is now, you can't use the property. So look at the little regs or the little provisions in ATED. If it's damaged by an accident, so you can't use it, then you don't have to pay ATED. So this guy, on the one hand, he's unhappy. On the other hand, we've been able to claw him back sort of a year's worth of ATED, which is better than a kick in the teeth. Anyway, I'm not
pay for the cost of the repairs.
That's right. I'm not being flippant. I really am not. But it's good to know that I'm not the only one who has rubbish builders from time to time.
Oh no!
If any of my builders are watching, you're brilliant. Brilliant.
Plato is also a friend. He used to be a master carpenter, and he built a staircase in Kensington for this client. And they didn't pay him, so he went in and ripped it all out. Anyway, he ended up in the back of a van in a warehouse in East London somewhere. He was kidding. That's a long story.
Dear. Anyway, that's me done.
Thank you, Patrick. That is great. We'll put details on how to contact Patrick in the notes at the bottom of the podcast, as normal. And now up to Jane on VAT.
Right, hello. So I don't know how you want to play this, Simon. Do you want to ask me questions, or do you want me to just...
I think so. I think if we go through the common scenarios that we get asked month in, month out, maybe start with option to tax. What is an option to tax? What was it attached to? How do you revoke it, and so on?
Yeah, okay. Well, an option to tax is something that only applies to commercial properties, and it's something that people have to they decide to opt to tax the property, and then they have 30 days to notify HMRC of that option. And what that does is, where land would generally be exempt, it turns it into being a taxable supply. And the reason that an option to tax would be made is in order to recover any costs that you're incurring on that land. So if you've bought a piece of land that had already been opted, and you've incurred VAT on that land, and then you're going to construct a building on that land and incur more VAT, then if it's a commercial property that you're building, then you may want to opt to tax, depending on what you intend to do with that building after you've built it. So if you plan to sell it, then if it's a new commercial property, it's automatically standard rated, so there's no need to opt to tax. If you plan to let that commercial property, then that would be exempt and you would need to opt to tax. If you're purchasing a commercial property that somebody's opted to tax, but you intend then to convert that property into residential, then there's a possibility of getting that option to tax disapplied. So you'd need to fill in relevant forms and provide that information to the seller before the relevant date. So the relevant date is usually the date that you agree a price for that property. But and the seller can't say that he doesn't want to disapply the option and that he won't accept the notice. But what he can do is say, well, I'm going to pull out of the sale and I don't want to sell this property to you because I don't want to disapply my option to tax. The reason he may not want to disapply his option to tax is probably to do with the fact that the reason he actually opted to tax in the first place was to recover VAT on costs.
Yep.
Now, if those VAT on costs exceed a certain limit, say 250,000, and was incurred within the past 10 years, then if that option to tax was disapplied, the seller would then be in a situation where he has to repay a certain amount of VAT back to HMRC. So that could be a reason why he says, well, I'm not selling the property to you, I'm going to sell it to Mr. Bloggs down the road because he's not converting it and he's going to carry on using it as a commercial property and there's no problem. In that instance, then I'd be saying, well, let's look at the figures. You know, how much input VAT is the seller going to have to repay if he disapplies his option to tax, and compare that against, well, how much extra stamp duty would the purchaser have to pay, because the VAT inclusive price is the amount at which the stamp duty land tax would be payable on. So therefore, you could be in a situation where it's in the purchaser's best interest to avoid paying VAT because he might save £20,000 worth of stamp duty, but the seller's saying, well, I'm not selling to you because I'm going to have to pay 10,000 back to HMRC. Yeah. So yes, as we know, we can recover the VAT if we charge the VAT, but obviously stamp duty we can't. So the purchaser in that case might be better off saying, well, okay, I'll disapply the option, you agree to it, and I'll pay you an extra £10,000 on the purchase price because I'm still £10,000 better off. Yeah. Obviously, that's not a VAT scenario. It's more of a commercial negotiation, but knowing and understanding the rules for the option to tax and the stamp duty in that situation puts you in a good position to negotiate.
Yeah.
Options to tax don't apply to residential properties, so you could opt to tax your interest in that property, but it just wouldn't apply. So where, for instance, you had a mixed-use property, so commercial and residential, and you opt to tax your interest in that property, it only applies to the commercial side of the property. But if at a later date you change the residential into commercial, then it would apply.
And isn't there a 6-month limit where you can revoke it?
Yes, so there is, if like you say, if you're buying from auction and you're not sure you're going to actually purchase that property, or you're not even sure you need to opt to tax that property, you can opt to tax the property, and then if you look back then in 6 months, you've got a cooling off period that says if you don't make any supplies, then we can revoke that option.
Because like at the moment, we have that client, don't we, at the moment, who's buying a shopping centre.
Yeah.
And of course, we've notified to HMRC the option to tax and done all the things that we should do, but it's unlikely that we're going to get the actual letter from HMRC before they complete this week. So you can still sell, can't you?
You can, yeah, and that is, I mean, me personally, if I was acting for the seller, I would be saying we need to see the acknowledgement from HMRC, because even though the purchasers have put in the VAT registered or they've put in the option to tax, we don't know for sure that that option to tax has been done correctly. You would want to see the application forms that have been submitted, but I would always say, if you're going to sell without those documents, then I would be asking for the VAT amount to be put into some kind of escrow account just in case. If I was acting for the purchaser, I would be arguing that the paperwork I put in is all correct, here's copies of it, and there shouldn't be a problem, and therefore sell to us.
Yeah.
Usually there isn't a problem, and saying don't sell or put a deposit in an escrow account is being really very, very cautious. Yeah. But you definitely want to see the notifications that's been put in and the application, and make sure that you know, if the client wasn't already VAT registered, that the VAT registration is going to go through. But that was in relation, and the reason he was opting to tax in that situation is because we're trying to get the property across as a transfer of a going concern. And again, that results in, if we can get it across as a transfer of a going concern, then we get a stamp duty land tax saving again. But also with transfers of going concerns, they either are a transfer of a going concern or they're not a transfer of a going concern. So it's usually a matter of fact. So if the client purchased the shopping centre that was being, it's a property rental business basically. So if the purchaser buys that and then he opts to tax and VAT registers afterwards, he's going to be in a situation where he's made exempt supplies. Because of the price of the shopping centre, he's going to be under the capital goods schemes. So he wouldn't be able to recover the VAT all in one go. And he'd be in a situation where year on year, he's recovering a little bit of his VAT back.
Yeah.
If he opts to tax before he purchases the property and he's always making taxable supplies and his VAT register's got the option to tax in, then that is a transfer of a going concern. And if the seller said, well, no, I'm not seeing your acknowledgement, I'm going to charge you VAT, then that would be incorrectly charged VAT and wouldn't be recoverable. And as soon as the client put his VAT return in with that large amount on, HMRC would do an inspection and then they'd say, well, no, sorry, it's incorrectly charged, right, you need to go back to the seller. And at that point, the seller's moved back to Spain, to Marbella, and he's bought himself a nice pad and he ain't got that money to refund.
Where's it going? Yeah. Okay.
But the transfer of a going concern is really good if it's possible to, you know, if it's possible and it is a transfer of a going concern, then it is a great tool to for cash flow saving from a VAT perspective. But then again, you know, a proper a real saving with when it comes to land tax, stamp duty land tax.
Converted a commercial building into residential, and you haven't applied to disapply. What is there a negative impact to that?
Only the cash flow situation. So you're going to pay the VAT on the purchase price, and then again the stamp duty land taxes on the VAT inclusive price, and so that is a cost because you can't recover the stamp duty. So if you can disapply the option on a commercial property, it's always best to do so.
Right.
And briefly, can we touch on VAT groups? What is a VAT group and the benefits of using a VAT group?
Yep, so a VAT group is where a number of taxable bodies and entities get together and form a group, and they have to apply to be a VAT group, and they would do that so that any supplies between the members of that VAT group is disregarded for VAT purposes. And since November 1st, since the 1st of November 2019, it's originally VAT groups were just for corporate bodies, but since November 2019 now individuals and partnerships can join a VAT group, and you have to be eligible to join that VAT group. So you have to have an establishment, a fixed establishment, carrying on business, and somebody needs to be controlling the bodies within the VAT group. Then you make an application to HMRC. If they accept it, then you become a VAT group. And then one person within that group is what we call the representative body. And they're the ones that then account for the VAT. And there's one VAT number. You can't ever transfer a VAT number from a single VAT registration to a VAT group. So you'd always ended up with a different VAT number, but you've got the one body, they submit one return. They're all joint and severally liable for VAT when you're in a VAT group. So that could be one thing that might put people off a VAT group when you're buying and selling property with special purpose vehicles. Yeah. But like we've had one client where they had they'd bought the property in their company, they'd incurred over £20,000 worth of input tax on that property, getting planning permission, and then they wanted to transfer it into another special purpose vehicle in order to raise finance. But by doing that, because it was originally, they bought the property exempt from VAT because it was a derelict residential property. So then when they transferred that derelict residential property, there's nothing they could do to make it a taxable supply. So it would just always be an exempt supply, which means that the £20,000 input tax they'd incurred, they'd recovered it on the basis they was intending to build a new build property, which they wouldn't sell on, that would be at the zero rate of tax, which means they're entitled to recover input tax. But then because of the finance issue, and they had to transfer to another company, they was making it just a sale of derelict residential property, which is exempt from VAT. So that meant they was going to lose £20,000. So the way to resolve that would be to put the two companies into a VAT group. Then the supply from the one company to the new SPV would just be disregarded for VAT purposes. and then the SPV could then build the new build and then make a sale of that property at 0 rate, and then nobody would lose any VAT. That
So you
makes
think
sense?
now that is possible for a sole trader and a company to be part of the same VAT group?
Yes, or a partnership now. Yes, that's new. Yes.
Yeah.
So there's no other corporate link between them, bar. How does that work then in terms of an individual? Say if you had 3 parties, one of which was a company, an individual, and a partnership. So they've got no other corporate link. They're just
So they've got to have. There's got to be a corporate body. So somebody's got to have common control.
right.
And so if you've got an individual or partnership that owns a company, then they can join as a VAT group. So there has got to be some corporate control there. So it's not, I believe it's not that we could VAT register 2 individuals as a VAT group. But if you've got an individual who owns all the shares in another company, they could VAT group.
So it's common ownership basically, into or control.
Yes. Yeah.
Okay.
And I see in that scenario, it would be the company that would be the completing the VAT form and sending into HMRC.
Yeah.
Normally. Okay, cool.
Yeah.
Okay, well, thank you very much, Jane. That's really good on VAT. And Patrick, again, thank you for coming on to give us your wisdom on stamp duty issues and the complexity of non-domicile people, like myself. Wonderful. Okay, thank you very much.
Smashing. Thanks very much.
Cheers.
Bye.
Thank you. Bye.
Bye.
Bye. Bye-bye.